In this session, let's look at integrating the various financial analysis techniques which we have looked at, and probably the various modifications that are necessary for an analyst to be done to the financial statement so as they can be analyzed more effectively. So it deals with understanding of your inventories, how do you work with the multinational operations, how do you work with the depreciations, how do you work with the balance sheet. So all those things we have understood as a part of the financial reporting and analysis. The structures of the income statement, balance sheet, all of them have to be applied in an integrated manner to assess the worthiness of the company for an investment purpose. So when we are integrating it, the framework needs to be very clear for us. So just from a framework standpoint, to start off, it's better for me to understand what is the purpose of my analysis. Why am I doing? Is it for making a minority investment in a particular stock, which means buying a few shares of a stock? Or is it more from a bank providing a loan to a company that is trying to assess the financial statements? Or is it from the perspective of an acquirer who wants to take some stake or who wants to do a buyout of this particular company? So different requirements for different kinds of investors in the company. So as a financial analyst, first I need to be aware of from what dimension I'm doing this particular analysis. So it has to be very clearly understood from the clients as well as based on the guidelines of the employer. I will design a kind of objective statement, which is also called as a purpose statement for this financial analysis. For what purpose I am doing this? So for doing this, what all resources I require in terms of people, time, the data access, all these things will be, and even the budget, all these things have to be highlighted, got the necessary approval before we actually proceed further with the financial analysis. And then comes the next aspect, which is the data collection aspect, where what are the various sources from which the data can be captured? Yes, the annual reports and the annual reports, quarterly reports, or any other statements which are filed with SEC, all those can be obtained from Edgar. And apart from that, there are so many other things like discussing with the customers, discussing with suppliers, or probably looking at the press statements about this company, press releases and all. All these are also the other sources of information which I can get about this particular company. Along with that, so once I collect the data, I will try to organize it and then look at any kind of modifications or adjustments that need to be made to the financial statements, because we have looked at so many places where the manipulations are possible. So based on all that understanding, we try to prepare an adjusted balance sheet, adjusted income statement, and an adjusted cash flow statement, which is reflecting a better reality picture as per the analyst. And whatever are something like extraordinary, non-recurring, there are so many items which are worth omitting. So all those things, all those necessary changes have to really get into the financial statement, which can help in doing a much better analysis. So once all those adjustments are done, we can do some kind of calculations on those financial statements. So probably it can even go to the extent of calculating a few ratios, projecting some trends. All these kind of things can very well be done, and based on that, any deviation in the numbers, any large any very high or very low kind of numbers with respect to industry standards. By plotting some kind of graphs and trends, all that analysis can be done, and wherever there are significant differences or significant changes with respect to the past years or compared to the competitors, we will highlight them as areas of concern, and based on that we will create a kind of set of recommendations and some kind of conclusions about the performance of the company, and communicate them to all the necessary stakeholders in the process. And of course, whatever was the performance as per the last quarter need not be the performance as per the current quarter also. So once new data comes up, new news items come up, and some new other information about the company comes up, we take up that particular information, update our analysis, and probably that may result in changing the recommendations and vice versa also. So all these things contribute as a part of the effective financial statement analysis. So what I would like to drive now is the key things. Let's say I want to do one financial statement analysis. I have been supplied with a balance sheet and an income statement of a company, or probably the cash flow statement of that company also. Now, what are the key things I should look at? If at all, let's say the objective is investing or recommending it to an investor who want to buy few shares in the company. So how do I really look at some of these numbers so that a better analysis can come out? So from that dimension, I see, okay, one of the key ingredients for any analysis is the return on equity. This is how I start. I start off with one of the key ingredients of return on equity, which is the main reason why any equity investor is investing. He has to get much better returns for the amount which he has invested. So my starting focus is return on equity. Is it increasing or decreasing? If it is increasing or decreasing, try to identify what are the strong areas and what are the areas that require improvement. Probably the ROE may still be growing, but it is growing at the cost of something else. Or it is growing, but some of the areas of improvement are getting suppressed because of its growth. All these things have to be understood very clearly, and probably even if one area which can be improved is really improved, the ROE can go even more further. So from that standpoint, it's always advised that I break the ROE using the DuPont analysis. So generally we have looked at earlier also the return on equity, which we generally write as net income by equity. So I can very well improvise it as net income by sales into sales by total asset turnover into total asset turnover, total assets into total assets by equity. Even that will give me the same logic, right? And sometimes people have even given this extended DuPont model saying NI by EBT into EBT by EBIT into EBIT by sales or revenues into revenues by total assets into total assets by equity. So this is what we call as an extended DuPont model, where net income as a proportion of profit before tax. So the higher this number is, the tax burden is lesser. So my ROE can grow even if the tax burden is becoming lesser, if the tax burden goes down, the ROE can grow. EBT to EBIT is more called as interest burden. So even if the burden on the interest is coming down, interest rate and all, even then the ROE can grow. EBIT by sales, which is EBIT margin, which is more of a profitability ratio. So even if this can be increased, the ROE can increase. Sales by total assets, which is called as total asset turnover ratio. If I am using my assets more effectively, even then my ROE can grow up. And total assets to equity, which is nothing but financial leverage. If I am able to use my financial leverage also very effectively, my final return on equity can go up. So what this model says is there are 5 factors that are contributing to the return on equity, and if I am able to do better on all these 5 dimensions consistently, my ROE is going to grow up more and more and more. So what the analysts typically look at is, instead of looking at ROE growth or fall year over year or with respect to the competitors, look at all these 5 components year over year as well as with respect to the competitor. So if a company is growing on all these 5 components consistently, that is what is causing a more and more sustainable return on equity. Otherwise, if it is growing in one of the areas and at the expense of a fall in the other areas, then it means the sustainability of the same can have to be doubted. So that is where a DuPont and an extended DuPont kind of approaches will really help in terms of assessing what is contributing to the return on equity in what manner, and how can the return on equity of this company be improved further by addressing the areas of improvement. And even on a comparison note, it's better that I look at comparing all the 5 aspects of return on equity rather than looking at the aggregate. So that is one thing that is a key from analysis standpoint. Then the other thing that is suggested is look at the sources of income. Okay, the revenues. Look at the breakup of the revenues or breakup of net income. Are you getting these revenues and profits purely from the operations of the company, or are they because of the non-operating? So see the proportion of operating profit versus the non-operating profit, or operating revenues versus the non-operating revenues. If possible, remove all the non-operating revenues from the computation, from the assessment of the performance of the company, because if you have invested in an associate firm and that firm has started generating profits, and you add that profits to your net income, probably this year you are able to show a bigger number, but you don't have the control on the operations of your associate firm. So the profits of that firm, it's not mandatory that you would be receiving similar kind of profits in a similar manner on the performance of the other firm. So that may not be more and more sustainable, and that's the reason it is advised that whenever you are looking at the income statement, see what portion is coming from the regular operations of the firm and what portion is coming from non-operations. Even let's say we are talking about selling off some of the assets, selling off some of the investments, and because of that you got some additional net income. that may not be sustainable over a period. So from a company's standpoint or from a company valuation standpoint, it's worth that an analyst avoids all those things and plays around with only the sustainable or significant portion of the operations of that particular firm. So that is one reason. As a good financial analysis, it is worth looking at the sources of income and doing a breakup between the operating sources of income and non-operating sources of income and evaluating the profitability separately. Then the other dimension to look at is the asset base. See, when I say all these things, it has to be looked at over time for the same company over the past, and probably with respect to the competitors or the industry average. All these things have to be looked at from that multiple dimensions. So when I say asset base, look at the proportion of the entire balance sheet. Probably do a common size balance sheet. See how the proportions are varying. Are they more and more consistent? Because if the percentages are more and more consistent, it could give me a kind of a pointer that the operations are more or less stable. As the volume is increasing, based on that volume of sales, all these assets are also growing more and more stable. So the asset base, the proportion of the asset base over the period and across the competitors will give an important analysis in terms of the consistency of the company with the industry or the strategy which the company is following in terms of its growth, and how sustainable is this growth of this company. Because if the sales is growing more but the assets are growing even more higher, it could be an indication of the obsolescence of the assets in future, or probably unable to utilize the assets effectively. All these kind of things can come up. So identifying the proportions of the asset base over time and with competitors is one important part as a part of the financial analysis. Similarly, on the liabilities side, look at the capital structure, the proportion of loans, other liabilities like probably employee pensions, employee related long-term benefits, as well as the equity. Probably the loans and all are external, wherein there is a requirement in terms of paying of interest and principal within a duration, whereas when we are talking of employee based liabilities like pension plans or any other obligations like that, so in those cases probably there may not be any kind of big outflow of capital immediately, so it may not impact the performance of the company so badly. So at least look at what is the composition of the capital structure of the company across the period and with respect to the competitors, and based on all these things get into the computation of various working capital specific ratios. We have seen in depth in terms of various short term liquidity based ratios, and we know how to interpret each of these short term liquidity ratios, the current ratio, the quick ratio, and even relating to the inventory, days of sales outstanding, days of inventory on hand. All these things are relating to the turnover ratios, and converting the turnover ratios into the days by dividing those by dividing 365 by those corresponding turnover ratios, which will give me the average collection periods or average days for the inventory to get converted into a finished good. All these things can very well be considered as a part of detailed analysis, and at least for companies which are operating in multiple geographies and have multiple product segments, it is mandatory that they also give details of the revenues and expenses geography wise as well as segment wise, right? So it is important for the analyst to look at those numbers, which geographies are more profitable geographies, which of them are not so profitable for the company, similarly which segments are very profitable, and how much capital is being allocated to each of the segments. Is the capital allocation of the company in line with the profitability and the assets that are allocated to each of the segments? All these things can really form a very important basis regarding the investment in that particular firm. Along with that, look out for the quality of the earnings. We have discussed in our earlier sessions how do I check out for the quality of earnings using the accruals ratio. So you can use the accrual ratio to actually check out for the quality of earnings, and the accrual ratio can be computed either by using the balance sheet or using the cash flow statement. And if at all you find that the accruals ratio is very very high, try looking at the comparison between the cash flow from operations and operating income. If the cash flow from operations is significantly higher year over year or compared to the competitors, if the cash flow from operations is significantly higher, then you don't need to worry too much about the possibility of manipulations. Otherwise, we may have to think that some kind of manipulations or cook-up exercises might have happened within the within the financial statement. Then, apart from looking at all balance sheet and income statement ratios, I also suggest looking out for various cash flow statement ratios like cash flow from operations to total assets to total expenditure, all possible cash flows kind of ratios, because cash is more of a reality which is very slightly affected by manipulation, whereas all the elements of the income statement as well as balance sheet can very well be manipulated. So it's better that the analyst focuses more and more on the cash flow statement, and especially the cash flow from operations, which is more and more a sustainable element with respect to the performance of the company. And especially for the firm which is operating with multiple subsidiaries in multiple countries, or working out with so many investments in associates, it's always essential that you delineate the value of the firm in total and also compute the value of the firm standalone. If at all those associates and subsidiaries are not that profitable, or remove the value of all those firms and look at the standalone value of the firm, and based on that probably you can even compute the P by E ratio of the firm in isolation as well as P by E of the consolidated firm to see whether the firm in standalone is it undervalued or overvalued, or overall along with the associates is it undervalued or overvalued. And try to adjust the balance sheet wherever necessary. Any off balance sheet activities like operating leases and all that are done, make sure that all of them are reflected consistently. So it's always advised that all operating leases are capitalized, carried on to the balance sheet. So these are some of the things that have to be considered for much better analysis, and along with that check out if there are any kind of changes in the accounting standards and what kind of impact they can bring onto the financial statement. So whenever you are doing an integrated financial analysis, it is essential that you try to look out for each and every session that we have covered, what kind of impact each and every session will have on the financial statements of the firm, what kind of adjustments that need to be made by the learnings of each and every session to the final financial statement, and then get into the detailed analysis part, right? So this should give you that basic level of insight into the evaluation of financial statements in depth. Any further queries you have on this, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.